The stock market is hitting record highs, but ordinary people feel poorer than ever. That is the contradiction nobody wants to explain. Wall Street calls it a melt up, but on the street, it feels like something very different. It feels like a silent liquidation. Because when asset prices rise faster than wages, the market is not making everyone rich, it is separating the people who own assets from the people who only earn paychecks. A few hours ago, Graham Stephan released a video warning that the market may have entered a parabolic melt-up phase. He pointed to stretched valuations, Shiller PE ratios, and historical comparisons to some of the most dangerous periods in market history. But the most important question is not whether the S&P 500 goes to 7,500 or 8,000. The real question is much darker. If the market is booming, why does everyday life feel more expensive, more unstable, and more fragile? Welcome back to Broken Economy. Today, we are looking at the gap between Wall Street's melt-up and Main Street's breakdown. From the outside, Southern California still looks strong. The freeways are full. The office towers are still standing. The tech campuses still look alive. The coffee shops still have lines in the morning. But if you look closer, the cracks are everywhere. Insurance costs are rising. Electric bills are rising. Food prices are rising. Rent is still brutal. Mortgage payments are out of reach for many working families. And yet, the market keeps moving higher. This is the great disconnection. The financial economy is floating upward. The real economy is being squeezed downward. And the middle class is trapped in between. The first thing to understand is this. A melt-up is not the same thing as healthy growth. Healthy growth comes from productivity, rising wages, innovation, and a stronger real economy. A melt-up is different. A melt-up happens when fear of missing out becomes stronger than fear of losing money. People stop asking whether prices make sense. They start asking whether they will be left behind. That is when markets can become dangerous. Because the higher prices go, the more pressure ordinary investors feel to chase them. They hear the same message everywhere. Stay invested. Keep buying. Dollar cost average. Do not time the market. And for many people, that advice sounds safe. But here is the problem. When markets become extremely expensive, the same advice can turn into a liquidity machine for the people who want to exit. The public keeps buying. Retirement accounts keep buying. Passive funds keep buying. And the largest companies keep absorbing more and more of the money. That is how a market can rise, even while ordinary people feel worse. The money is not disappearing. It is being redirected. The second thing to understand is the Japan ghost. In the late 1980s, Japan looked unstoppable. Stocks were rising. Land prices were exploding. Credit was easy. People believed a new economic era had arrived. Real estate looked safe. Stocks looked inevitable. The entire system started to believe that prices could only go up. Then the bubble broke, and the damage lasted for decades. That does not mean history repeats exactly. America in 2026 is not Japan in 1989. But the psychology is familiar. Cheap money changed behavior. Asset prices became the proof of success. Regular people were pushed to take more risk just to keep up. And the longer the bubble lasted, the more normal it started to look. That is the danger. The most dangerous bubble is not the one that looks crazy. The most dangerous bubble is the one that becomes normal. Today, the new story is artificial intelligence. AI is real. The technology is powerful. It will change industries. It will change jobs. It will change the cost structure of companies. But real technology can still create financial bubbles. Railroads were real. The internet was real. Smartphones were real. Real innovation does not prevent overvaluation. Sometimes, it creates the perfect excuse for it. That is what makes this moment so dangerous. The market is not only pricing in AI growth, it is pricing in near perfection, massive productivity gains, massive profit margins, massive adoption, massive energy capacity, and very little disappointment. But reality is more complicated. AI needs power. AI needs chips. AI needs data centers. AI needs cooling. AI needs infrastructure. And someone has to pay for all of it. This is where the melt up moves from Wall Street into your monthly bills. Because the AI boom is not happening in some abstract digital cloud. It is happening on the same electrical grid that powers homes, hospitals, small businesses, and local communities. If energy demand rises faster than supply, somebody pays. If utility companies invest billions into infrastructure, somebody pays. If power becomes more scarce, somebody pays. And in many cases, that somebody is the ordinary household. The market celebrates AI capex. The household sees a higher electric bill. The market celebrates automation. The worker sees job insecurity. The market celebrates margin expansion. The employee sees fewer openings, more pressure, and less bargaining power. This is the part of the melt-up that rarely appears in the headline. The same forces pushing stocks higher may also be making life harder for the people outside the asset bubble. Now look at the third force, the passive money machine. Every 2 weeks, millions of workers get paid, and automatically, a portion of that paycheck flows into retirement accounts, 401 KS, index funds, target date funds, pension plans. That money enters the market whether valuations are cheap or expensive. It does not ask whether the top companies are overpriced. It does not ask whether the economy feels strong. It does not ask whether families are struggling. It just buys. And because the biggest companies dominate the indexes, more money flows into the same giants again and again. This is why the stock market can look strong, while the average person feels weak. The market is being fed automatically. But households are not. A worker may be contributing to a 401k while also struggling with rent. A family may see their retirement balance rise while their checking account gets crushed. A household may technically own stocks, but still feel broke every month. That is the difference between paper wealth and lived reality. You cannot buy groceries with unrealized gains. You cannot pay rent with a chart. You cannot fill your gas tank with an index fund. And if your retirement account is the only part of your life that looks green, something is broken. The fourth force is the death of organic savings. In the old economy, a middle-class household could earn, spend, and still save something. That savings could become a down payment, a safety cushion, a business idea, a path to freedom. But in the new economy, the surplus is disappearing. Housing takes more, insurance takes more, healthcare takes more, transportation takes more, utilities take more, food takes more, debt payments take more. By the end of the month, there is often nothing left. So the economy creates a strange illusion. Asset owners feel richer. Wage earners feel trapped. The stock market says prosperity. The household budget says pressure. This is why consumer sentiment can look terrible, even when financial markets are strong. People are not stupid. They feel the squeeze directly. They may not know the Shiller PE ratio. They may not follow chart overlays from 1929. They may not know what a parabolic melt-up is, but they know when their paycheck no longer stretches as far. They know when a grocery run feels like a financial event. They know when insurance premiums feel like a second rent payment. They know when a six-figure salary no longer feels like security. This brings us to the $100,000 salary problem. For decades, a six-figure income represented success. It meant stability, comfort, a middle-class life, a home, a car, savings, a family, a future. But in many expensive American cities, that old meaning is gone. A $100,000 income can now disappear quickly. Federal taxes, state taxes, rent or mortgage, car payment, insurance, utilities, groceries, healthcare, student loans, credit cards, childcare. By the time the month ends, the number that looked impressive on paper can feel surprisingly weak in real life. That is not because people suddenly became irresponsible. It is because the cost structure changed. The economy moved the goalposts and then told people they were failing because they could not keep up. This is the emotional power of the melt-up economy. It makes people feel like they are falling behind during a boom. That is psychologically brutal, because when markets are crashing, people understand why they feel nervous. But when markets are rising, people are told they should feel optimistic. If they do not, they blame themselves. They think they are doing something wrong. They think they miss something. They think they are the only ones struggling. But they are not. The contradiction is built into the system. Stocks can rise because companies cut labor costs. Stocks can rise because consumers take on more debt. Stocks can rise because passive money keeps flowing. Stocks can rise because the currency loses purchasing power. Stocks can rise because the biggest companies become more dominant. None of that guarantees that ordinary life improves. Sometimes it means the opposite. Sometimes the market rises because the real economy is being squeezed. This is why the melt-up should not be viewed only as a celebration. It should be viewed as a warning. When asset prices disconnect from household reality, society becomes unstable. People begin to lose faith in the system. They see headlines about record highs. Then they look at their own life and see no record highs anywhere. Not in their savings, not in their wages, not in their security, not in their future. That gap creates anger, and anger becomes political. Economic pressure never stays economic forever. It spreads into culture, into elections, into family decisions, into birth rates, into crime, into mental health, into trust. A broken economy does not break all at once. It breaks quietly, one bill at a time, one layoff at a time, one rent increase at a time, one grocery receipt at a time, one person at a time, realizing that the old deal no longer works. So what should people actually watch? Not just the market. Watch the spread between asset prices and wages. Watch energy costs. Watch insurance premiums. Watch credit card debt. Watch layoffs. Watch small business closures. Watch whether people can still save after paying for basic life. Because that is where the real economy lives. Not only in the S&P 500, not only in AI stock charts, not only in earnings calls. The real economy lives in the distance between what people earn and what survival costs. And right now, that distance is getting dangerous. That does not mean a crash happens tomorrow. Melt-ups can go further than people expect. Expensive markets can become more expensive. Bubbles can grow larger before they break. And people who warn early can look wrong for a long time. But that is exactly why this moment matters. The higher the market climbs, while ordinary life gets harder, the more fragile the system becomes. Because, eventually, someone has to answer the question, if everyone is getting richer, why does it feel like everyone is under pressure? That is the question at the center of the broken economy. Go to the comments and tell us what you see in your city. Do you feel the melt up in your bank account? Or only at the gas pump? Are restaurants getting quieter? Are insurance bills getting worse? Are homes sitting longer? Are people working more but saving less? Because Wall Street has charts, but the street has evidence, and the evidence matters. The melt-up economy may look like prosperity from the top, but from the road, it looks like pressure. Subscribe to Broken Economy for more clear breakdowns of the financial system, technology, and the real economy behind everyday life. Stay awake. The chart is not the whole story.